Building and renovation costs money, but bad financing costs more, especially if you don't understand how construction lending actually works.
The vast majority of construction that we have done has been through a fixed price contract. There's lots of extra costs that you need to factor in. It's a good idea to have a bit of a slush fund. Construction is not for the faint-hearted. It's stressful and you need to be organised.
In this episode of the Investing for Doctor podcast, I'm again joined by Eloise Dooley from Two Birds and One Loan, and we're unpacking what doctors need to know before starting a renovation, extension, or knockdown rebuild project. In this episode, you'll learn when a simple equity release is enough and when you'll need a full construction loan, how banks assess your home's value before and after your build, why progress payments, builder contracts, and unexpected costs can completely derail your project, and what one needs to do if your builder goes under or you run out of cash midway.
Lenders don't like unfinished securities. If you're going to undertake structural renovations, you need to make sure that you can complete them, because you don't want to be in a situation where you've got an incomplete security. Just engage your broker early or engage your banker, because they're there to help you and make sure that it doesn't fall over.
If you're planning structural changes or renovation, this episode will save you from costly surprises and lending traps most doctors never see coming. Now let's get into it. Hi everyone, welcome to another installment of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have Eloise back with us again.
Thanks,
Hi, Eloise.
B. Thank you for having me.
Yeah, very briefly, who you are, what you do,
Yep.
and we'll...
So my name's Eloise Dooley and I own Two Birds, One Loan, an existing brokerage with Alyssa Childs. And we've recently partnered with B to form IFD Lending. So you've probably seen us responding to some of the posts on the Facebook site. It's a really exciting partnership, and we've already worked with a few of you already. So very exciting.
Excellent. So welcome back. And we have seen a couple of questions come through our sort of group. And I think one of them that always gets people talking about is on construction and renovation. And a lot of doctors at some point in their life want to refresh their existing owner-occupied or add an extension or even add an extra floor to that.
Yeah, or even knock down rebuild.
Oh yeah, a knockdown rebuild, right? I mean, that's, or they buy the land with a little,
that's right,
dodgy little house on it and then live in it and then rebuild it. So the problem with that is that the lending side of things gets a bit trickier compared to just the usual buy an existing property, lending
it does.
from the bank. How is that different? Is there a completely different product? Is there completely different processes? And
So not all lenders will offer construction. I mean, all of the big four offer construction. That's just
so
a given.
It's a different type of loan, isn't it? Is there called a construction loan?
It is. There's I mean, look, there's a few different ways that you can do construction, and it all depends on exactly what you want to do to your property and the extent of the renovations.
Okay.
For example, you might just want to redo your kitchens and bathrooms, not touch anything structurally. You might need 200K to do that, and a bit of landscaping or whatever it is. So, that's fairly straightforward. You don't need a construction loan.
No, you could almost get some equity release, I guess.
Yeah. In that instance, you would just say, hey, I need 200K, to, do X, Y, Z to the house. Depending on the lender, they might ask for, just for you to detail what you are going to use the funds for. But, if it's under 80%, if they see that you're a doctor, chances are they'll ask minimal questions. It's generally quite an easy process as long as you service, and, doctors can take it up to 95% with no LMI if you wanted to cash out, whatever that is. So, So you get your cash out, you control the funds, you control all the trades, everything else easy. And then you sort of step it up a notch and you go, okay, what do we want to do now? We want to add a bedroom. We want to add a second level. We want to do a pool. We want to do all these things. And, that might be, 500K, 600K, whatever that is. So in that instance, as soon as the cash out amount starts to increase, the lenders start to go, okay, what are you going to use that for? Are you structurally changing your security? Because, the banks own this security, right? So
the bank owns the property until you've completely paid it off. So you are technically altering their stuff.
Yeah, that's right. So, and they, if you tell them it's for structural purposes, there's a chance that they're going to want to control the funds.
Okay. So before we head down that way, what is the definition of a structural change?
So a structural change is, you know, where you're structurally changing
As in the
your
outside,
home. So
or-
where you're sort of ripping off walls, changing
Yeah.
it structurally, adding a bedroom, you know, significant changes to the house that change the security.
Okay.
And there's probably a little bit of a grey area because, I mean, you know, I think,
I'll
it just,
give some instances because
Yeah.
it's then you say structural, not structural, maybe.
Yeah,
All right.
yep.
So if I added a extra bathroom,
is it, I mean, if you're
it's within the confines of
I think if you're renovating the bathroom within the house and you're not changing any of the framing, then that's fine.
Yeah,
You can just
okay.
manage that yourself.
If I wanted to knock down a false wall to make 2 bedrooms, 1 bedroom.
Oh, that's probably a bit
structural.
I mean,
isn't
it depends on, I mean, if it's only going to cost like, it's probably non-structural if you're just knocking out a wall in between, you know, two rooms sort of
Or a
thing, as long as
divider,
you don't need to put up any big RSJs or, you know, structurally change the home. You know, I think if it's under a certain threshold,
It's okay.
it would be okay. But, you know, if you're adding a garage or adding a bedroom
or a granny flat. And
granny flat or going up, like ripping the roof off.
Yeah. So the outer, I think if you change the outer enclosure of the place.
That's right.
That's
The
gonna be
existing
structural.
footprint of the house. I think if that changes, that's when it's going to be
What about
structural.
adding a pool?
Adding a pool, we have done cash out for a pool.
Yeah.
Before.
Is that structural or not?
Yeah. I mean, look, we would still declare that you're putting in a pool.
Yeah.
Because it's obviously, and it depends on the value of your home and how much you want to borrow to, because that pool's going to add value to your home, right?
Yes.
So, you know, some of the benefits of having a construction loan is that they will do an as if complete valuation. So they will take into consideration all the improvements, the new pool, the extra room, all the improvements that you're doing and add it to the value of your home already. And they might go, okay, your house is worth 1.5 now. You do some renovations, it's going to be worth 2 mil.
Even though the cost of that is less than $500,000.
Yeah, possibly, or whatever it is.
Or you want that. You want to
That's
spend
right.
less and add more value, right?
Yes,
You don't want to
generally they'll just add the cost of the construction costs onto the value of the home. They'll come out and they'll do a full inspection. They will review all of your plans. They will have a look at what you want to do. They'll have a look at the costs, the finishings, exactly. And then they will determine what the end value of your home will be. And then they will base your lending on that as if complete valuation. So that's actually one of the big advantages of doing a construction loan is being able to use that future value to lend against. So, you know,
before we start, because we're getting to the end now, like before we even start, when do we go tell the bank we need this? Like, is this at the part where you engage the architect? Is this the stage where you have your quotes for your construction, or is this the place where you're about to say start paying people?
Yeah, I think, you know, engage.
You know,
we've got clients on our book that we engaged, you know, 1 year ago, 2 years ago, and they go, look, how much can we borrow? What can we do? And we generally just start by having a bit of a conversation around what exactly do you want to do? How much do you want to spend? And then sometimes they need to work backwards from there because, you know, some clients may be restricted by their borrowing capacity. So they might need to figure out what they're comfortable repaying every month. You know, they're like, we don't want to pay more than X every month. So let's work backwards from there. And then they can go and have a chat to the architect or the builder or whatever and go, look, we want to do this. It needs to fit within, you know, a $500K budget or whatever it is. And then at that stage, we can, depending on what it is, I mean, look, if it's just a cash out, we can, you know, cash out and have the funds there ready to go if you're just going to do your kitchen, bathroom, whatever it is. If it's construction loan, we can actually get a pre-approval and we'll take all the plans and the lender will do what's called a construction val. So they will take into consideration all of those improvements that you're doing and then they'll come up with the final valuation. And then we can get an idea of where the LVR is sort of sitting, how much you want to borrow. And then quite often the client will go back to the builder and say, oh, I actually don't want to spend that much. I need to keep it under X LVR. I want to pull it back to 400K instead of 600K or whatever that is. So quite often we will do a lot of work up front with the client, just sort of toggling with those numbers based on their requirements and based on what they want to do to their property. Because with a construction loan as well, they have the lender will control the funds. So they're not just going to release all that money to you and go, hey, here, do a structural renovation on your home, they will say, okay, great, you need to come back to me, with a progress payment schedule that says, this is the first stage, second stage, third stage. Essentially, the bank wants security that it's going to be completed.
And it's progressing as they intend.
That's right. Because at the end of the day, they don't want an incomplete security. They want to make sure that you finish it and then it's done. And, for whatever reason, if it goes wrong, they want to make sure that, they can complete it and put it on them.
So obviously that depends on what the builders have put in, what the architects has put in terms of the design, in terms of the progress of the build and how much it costs for each stages of that.
That's right.
Do you find that whatever the builders quote that the builders give is going to be tailored towards getting that loan approved in a particular fashion, or the bank coming back and say, okay, this is what you want, this seems reasonable, let's just go for it?
Yeah, so the valuer will actually review all that stuff. So they will take it's generally an HIA building contract, and it's a standardized contract that's rolled out across the industry, and they have a set of parameters in which they need to abide by. So particularly in regards to the progress payments, so, there might be 15% up front and then another 20% and then another 20% and another 20%. Yeah. And then there's all these, and the banks do their due diligence with the builders as well. So they ask them for all their different insurances, their professional indemnity, their builder's insurance. They, they have to get an industry specific, contract with progress payments that meet the bank's requirements. And, there have been times that we have got a contract and it doesn't meet the bank's requirements. So we have to go back to the builder and go, no, you're asking for too much up front. You need to put more weighting here or more weighting here in terms of when the cash is distributed to the builder. And then, that's for a fixed price contract situation. But, increasingly with, construction, a lot of builders are wanting cost plus and things like that. So that might sway what lender we put you with if you want to do cost plus. And then there's also the owner builder route. So, I've had a few owner builders in my time.
Okay.
And, they're a little bit trickier to get across the line, and you really do need to know what you're doing, and you need to be look, to do construction in any case, I think you
need a license.
You've got to be up for, yes.
Yeah.
You've got to be up for it, but it's very detailed. It's very, you quite often need to get QS reports done. You need to get them out at every single progress claim. You need to make sure your quotes are up to date. You need to be very organized and very meticulous if you're going to do owner builder. And also the LVR requirements are a lot lower. So owner builder, you can really only do 60%, through one major bank.
Owner
builder,
very limited scope.
Very limited options because the risk is higher. And same goes for high-end builds. So, once your build gets over a certain threshold, the lenders will ask for additional information. So they might ask you to get a QS report or a costings report just to make sure all your costings are on par, like where are all the funds going to, because, as we've seen with some high-end builds, that sometimes the cost of the actual build doesn't translate to value at the end of the day.
Yeah, so when we say, that you borrow $500,000, it adds $500,000 value, but your build is like $1 million, but you're only adding 600, 800.
That's exactly right.
Because, people are not valuing that architectural splendor that you have envisioned, I guess.
Yeah, that's right. That's right. And you've got to have a look at how, if you sell this down the track, what will be the appetite in that certain area? Will it sell? It might be architecturally designed and have all the high-end finishes in the world, but is there an appetite in that market that will buy it? And that's how the banks see it. Obviously.
Or there is an appetite, but that kind of buyer is
quite
so
limited.
rare.
That's right.
Yeah.
That's right. So, construction is not for the faint-hearted. It's stressful, and you need to be organised. Look, the vast majority of construction that we have done has been through a fixed price contract.
Yeah.
And, everything from, your structural renovations all the way through to even a knockdown rebuild, because that again is something different again.
Yeah.
So, there's lots of extra costs and things like that you need to factor in.
Yeah, the removal, the knockdown costs.
That's right, the demolition cost. That's right.
Because you're getting rid of value to
Yes.
put on more value.
Yep.
And so the cost of that might be way more than
That's
the
exactly
final
right.
value.
That's right. So quite often you do need to have, it's a good idea to have a bit of a cash
Buffer.
slush fund when you are doing knockdown rebuild, particularly because there's lots of costs that will hit up front if you're going through an architect, if you need to do demo, rubbish removal, council fees, levies, all these things that quite often need to be done up front. It's good to have a little bit of a slush fund. But yeah, look, you do need a lot of equity to do knockdown rebuild. We haven't seen too many of them. Quite often people will buy vacant land and build rather than, knock down an existing security.
Yeah, exactly. And talk about the fixed costs and the cost plus model. From the, just because it's a fixed cost doesn't mean they're not going to have cost blowouts.
Yeah.
Because the way we see how construction has been in the last couple of years, there's been a lot of uncertainty in that market. There's a particular place near my practice where they've had the fences there for nearly a year now, and there's still a wall that's missing, and it just halted.
Yeah.
So what happens in those situations for the two different models of payment?
Yeah, I think, with cost plus, they'll generally ask for a contingency. So they will build in some sort of buffer, and same for the high end builds. They will always build in, a 10 or 20% contingency that you either need to hold in cash or that you need to borrow when the lender holds it.
Yeah. So is that from the bank or is that from?
Either or. It just depends on your personal servicing position and your cash position, but they will generally request some sort of contingency to avoid that sort of thing. And, even with fixed price contracts, it doesn't happen too often, but there will be some variations from time to time that do happen. Particularly, you might be, cut and filling a block of land, and you might need some sort of retaining wall that you didn't envisage that you needed when you did the initial survey, survey and that sort of thing. So sometimes we do need to go back to the drawing board and just figure out, what we need to do. On occasion, I will say if we can just get this house to OC, if we can get it to the final approval, get it to OC, get it through, and then once we've got it to OC, there's a chance that it will value up because
the occupancy certificate.
Their occupancy certificate, that's right. So once it's completed, the valuation that was originally provided by the bank is more than likely conservative.
Yes.
So once you've got your occupancy certificate, you can then do a new valuation, and then we can get a top up, because once you're in that construction loan, it's very hard to change them. So if we can at least get it to occupancy certificate, we can then get some sort of top up the funds, you can finish off what you need to do.
Yeah. For those that don't know, it's like the occupancy certificate just means certifies that the building is ready for someone to live in. That means it's sealed and
it's done. It's locked up. It's ready to go. You can live in it. It's painted.
Yeah, but it doesn't mean that the internal fixtures, such as the kitchen, might be done.
That
might still be incomplete. And
I think the kitchen would need to be done for OC.
For OC?
Yeah, definitely.
Okay, but certain things don't need to be done.
Landscaping, for example, is a good one. So things like finishing off your driveway, finishing off all the landscaping and things like that. And stuff does happen when you build, and unexpected costs always come up. So, it
seems like that's probably more the norm than the exception these days.
It is. And I always people, I'm like, just get more than what you think you're going to need. I said, at the end of the day, if we've got a surplus, if we get to the end and you've still got 20, 30 grand left over, I said, we can put it back into the loan. We can reduce your limit. We can do, whatever you need to do. I said, but just have it there ready to go, because you just don't know what you're going to get.
Yeah. Don't go up to the eyeballs and then
that's right.
That little sprinkle of salt.
That's right. That's right. Particularly with renovating. Renovating is particularly expensive. I think they say it's about 3 or 4 times the cost per square meter than doing a new build. They say it's very expensive, because obviously you're trying to remove all the old stuff and from a time perspective, and just trying to integrate it with the existing house, that sort of thing. It is an expensive option, but if you're in a good house, good area, your kids go to school there, lots of people choose to renovate. Yeah.
Okay. All right. So it sounds like we've touched a bit about construction loan when you're doing a renovation or significant modification. So for a knockdown and rebuild, as we mentioned earlier, there's usually additional cost involved in demolishing everything.
That's right.
Do they lend against that cost of that, or that's just a cost you just have to have?
No, for knockdown rebuild, you really need to be in a strong equity position.
Yeah.
You need to, I mean, sometimes it's wise, like when you're doing sort of the exploratory phase of a knockdown rebuild, is maybe even access some equity upfront.
Yeah.
You know, get 50 or 100 grand out and have it sitting there in cash, just to, you know, get all your plans drawn up, get them all approved. You know, and when you start your build, there are things that you're going to need to do that aren't necessarily going to add value to the home.
Yes.
So for example, you're going to need to demo your house. There's going to be rubbish removal. There's going to be, you know, there might be putting stuff around trees to protect them. Like there's all these things that need to be done in advance of commencing that the bank, you know, that's going to come into your contract and is going to be, you know, might be 100 grand worth of cost, but isn't going to add to the value of your home. So depending on your equity position and where you're at, you know, I would recommend getting out some money to begin with, just to fund that first part of the process. And then once you get to the build stages, all you really need to do then is fund the build of the house and, you know, the progress payments, whatever.
So in a way, if you already have significant equity in the place, or you own the place outright, it's a lot easier to get a loan for a knockdown rebuild.
Yeah, that's right. Because you've got to remember, when you're doing a knockdown rebuild, the house that's there is going to go. So the value of your property, when the banks look at your as if complete valuation, they're working off land value only.
Yeah.
So they'll come out and they'll do what's called a full valuation, where they look at the value of your land, and then they look at what's called the improvements, which is your house.
It's the house, yeah.
But if you're knocking that down, the banks will just look at the value of your land plus the value of your build. So for example, your land might be worth $1 million, and then you might want to build a house for another $1 million. So, you know, your as if complete valuation will be $2 million or thereabouts, just depending on, you know, if it's, you know, a high end, low, like what sort of build it is. But yeah, you just got to remember that, you know, you're going to wipe a lot of, you know, your equity off once you demolish that house. But improve it incrementally.
Yeah, and once you do it, you better hope that you can finish it. Otherwise, you're left with.
That's right, and that's what the lenders are, you know, want you to do. They want you to finish the build. They want to make sure that, you know, you can complete this build, and that, you know, the land plus the build cost is generally a conservative approach to valuing your property, and more often than not. Once the property is completed, you do a new val, it might be worth 2.5 or more than that. So, you know, that they have these mechanisms and way of valuing in place as a conservative way to protect you.
Yeah. So essentially it sounds like a construction loan and all these things. It's almost like a bridging loan until you have from an old form of your place into a new form of the place.
Yes.
And then you put another full valuation on that afterwards. And hopefully that you've added more value than you've destroyed in value.
Right.
And
and another thing I wanted to mention is another benefit of doing the construction loan is that they're interest only until they're fully drawn. So let's just say you've got, you know, a construction loan of $500K with, you know, 5 100K incremental payments. You will only pay interest only on that first 100K as you draw down on it.
Yes.
So, you know, quite often you'll have to move out of your home and into a rental property and somewhere else. So it's a good way for you to manage your rental costs and the build at the same time. So, you know, if you access all of that equity up front, you get that 500K cash out, you're paying P&I repayments on that from day dot.
Yes.
You know, whereas if you get the construction loan and it's incrementally staged over a 12-month period, you're only going to be paying incremental repayments on that.
The effective rate is lower.
That's right, as you draw it down. And then the idea is once you have completed, and we keep an eye on this along the way, is that once you have completed that last progress payment, we then have a chat and go, do you want to keep it on P&I for, you know, have you got anything else to do? Do you need to buy furniture? Do you need to keep your cash flow light for the next couple of months? Do you want to keep it on interest only for a short period of time, or do you want to flick it over to
so you
P&I
can just keep
now?
it on interest only for a little while.
Generally, the lenders will give you about a 2-year interest only period.
Oh, right. Okay.
I know with Macquarie, they'll do 2 years interest only, and then, you know, you actually have to request to put it back on P&I. Otherwise, they'll just do it for the full 2 years.
Yeah. And is the rate substantially higher or?
Depends which lender that you go
Yeah,
to. So, some lenders, they switch it to interest only and it might be 20 points higher.
Yeah.
Some lenders will just do the P&I rate at IO rates.
Yeah. But it's not going to be like, 8% or something.
No. Yeah, I mean, as long as, if you stick to sort of, majors or second tier lenders, the construction, the interest only for construction is generally pretty close to the P&I.
Okay.
Which is good, which is, it's there for a reason. It's to help with cash flow whilst you are undertaking such big changes.
Yeah. Okay. So they sound like very reasonable sort of lending policies.
Yes. But again, do your research. Just make sure that, you've dotted your I's, you've crossed your T's. Like, don't leave anything to the last minute. Plan everything out because, you will need contingencies. Like, everyone always needs extra money for something. So just if you can afford it, make sure that you've got, a little bit of a slush fund of a contingency cash pile.
Yeah. And also to figure out where you're going to live while that's happening.
Yeah. Yes.
I think that's the other thing that often people don't think about, that you're going to incur extra costs by either renting a place and the schedule might not be the same schedule you anticipated.
Yes.
So you drag out even longer.
I know. I mean, if you're fortunate enough to be able to move in with family, we have lots of parents, lots of people that go and perhaps move in with their family whilst they're doing this. That's not for the faint-hearted either.
That has its own complications.
But if you can manage to find a rental property close to where you are, then you've got to factor in that cost too.
Yeah, and I know stories where I have colleagues where they had to move the entire family back home, and it can be quite trying because you're so used to living outside on your own by your own rules, and now you're back at
mum and dad's.
Could be a good thing or a bad thing, depending on your personal relationship with your parents.
That's right.
Yeah. So any other sort of pitfalls or considerations you think about when we do some renovations or?
No, I think it's just all about being organised and just engage your broker early. Like, even though you might not be ready to move right now, I think it's good to have a conversation up front and just get a little bit of a game plan in your head. Just have an idea of, what the costs are before you start constructing and what you're going to be up for, and then what the second phase sort of looks like. There's never too early to engage us. Just because you chat to a broker now doesn't mean you need to move on it now. We've had lots of people on our books that, will check in with us every 6 months and go, oh, this has changed. What do you think about that? And quite often it is a sliding scale. And, you just need to be a bit malleable.
Yeah. It sounds like the next episode we need to find an architect to come and talk about these things.
I'm sure they'll have a different perspective on it.
I mean, I've got some personal experience with building because I had a greenfield development, a medical practice, and I remember as we're building, one of the materials we wanted wasn't available all of a sudden. And to get it, we had to import it from somewhere else, a similar thing. And we just scrapped it and used ColorBond, and we saved a lot of money in doing so. So, not quite the architectural vision, but
I know, and that's right. And I think sometimes you've just got to have a clear, well, not clear, but things that you're willing to move on,
to compromise on.
To compromise, exactly. That's right. Yeah.
And sometimes that can save a lot of money.
Yeah, that's right. I know. Even just workshopping those first initial plans. Quite often we've had clients that have come to us and said, here's all the plans, this is how much it's going to cost. I'm like, we need to scale it back a little bit. And then once they go back and do that second round, it's amazing, the things that you can compromise on and save costs and things like that. So, it's important to have a good builder and,
And so how, we obviously engage other sort of professional services as well. When do you get say a quantity surveyor to come in and look at that build, and then when do you just rely on the builders themselves, or when do you rely on what the architects say? Because there's so many different professions in all of that.
So generally the QS report doesn't come till right down the line. So that will be closer to when we get it all formally approved. So we might do a pre-approval for, a build, and we've got all the plans, we've got all the costs, we've got everything ready to go. And then in order to start the first progress payment, we need to have the approved plans.
Yeah.
We'll need to have, the final progress payment. We need to have all the insurances in place. And then at that stage, they might request a QS report.
Yeah.
That's right.
So I guess my question to that is that would it be useful to have a QS person come in earlier and assess that?
It depends on the timeline of the build because costs can change over time.
Yeah.
So, I've got one client, so he did a QS report, 12 months ago, and now we're sort of at first progress payment stages. And the costings have all changed because the construction industry has moved and, supply issues happen and all the rest of it.
Yeah,
so,
supply chain.
I think you've just got to be guided by the lender a little bit too. So they will let you know at certain milestones when you need to have something. And more often than not, it will be for the, not all of them require QS reports. That would probably be for an owner builder outside of spec. That's probably in a bit of an extenuating circumstance, to be honest. But in this instance, we did the QS report for the approval and now we're going to do another QS report for the first progress payment. And I think they're going to want it updated along the way. But that's an owner builder situation. For anyone else that's just got a fixed price contract, that they might not want that. It should be fine. It should be fairly straightforward.
Yeah.
So I don't want to scare too many people off.
No, but we gotta workshop all the the doomsday scenario, right?
Yeah.
I mean, obviously the last thing you want is for your builder to go belly up.
That's right.
During the build.
That's right.
Has that happened before in your experience?
Oh, look, we have had
What
builders.
then?
I mean, look, you just have to, they can't complete the build. If they don't have any money, they have to foreclose on the job. You just have to get a new fixed price contract and get everything in place and get it finished.
Yeah.
Yeah.
And what
it's in the lender's best interest to finish the build, right?
Oh, of course.
Yeah.
Of course.
So it's not ideal, but under any circumstances.
Yeah.
But look, it does happen. And, there have been instances where, the client has been, left out of pocket and things like that. So you've just got to workshop it because all situations are just so different.
Yeah, it depends on
but
what
you just got to go, that's right. You've got to go back
Yeah.
to the drawing board and you might have to, redo the loan approval or whatever it is.
Yeah.
Yeah.
But it can be done.
It can be done. Yeah, of course. It can be done.
It can be done. It's painful and everyone's upset. But it's not the end.
That's right. And we have had instances as well where, someone will come to us where, they might have had a heap of cash sitting in, they might have had a heap of cash and they're like, great, we're going to do some structural renovations ourselves.
Uh-huh.
And you go, oh, okay, rightio. And then they've got, 70% of the way through and alas, they can't finish it. So they've run out of money.
Yeah.
They can't finish it, whatever the costs have blown out.
Oh, dear.
And, in the eyes of a lender, lenders don't like unfinished securities. So, because it's risky for them, right? So
this is before they have an OC, obviously.
Yeah, that's right.
Yeah.
So they might have just done them themselves without doing a construction loan. So they've just got their money from their bank and gone, great, we're going to do
and
some.
then they hire some tradies. They come in.
Hire some tradies, get them in. They go, oh my gosh, we've run out of money. And then they come to us and they go, can you give us some more money? And I'm like, oh, you've got an unfinished security. But, we have had not all lenders will do it. Lots of lenders don't like it. It's risky for them. But there are lenders that will do it depending on how far through the process you are.
Yeah.
If something's, only 20, 30% complete, it's going to be trickier than something that's 70% complete.
Yeah.
We've had some success with some majors that will pick up an unfinished security at sort of 60 or 70% complete, but you need to have a clear plan, you need to have an action plan, you need to know that it's going to be finished. And, look, everything can be done at a cost, right?
Yeah. How much pain and how much cost.
Yeah, that's right. I'm like, if you have a unfinished property,
you can get an unsecured loan even if you really want
that's
to.
right. The private space will do this, but again, you need
15%.
That's right. It will be expensive. You need to read the terms and conditions very carefully. You need to have a very clear exit strategy as to what happens at the end of that funding facility, because quite often they are, only 2-3 year facilities. So you need to know that you can have the capacity and the means to refinance out of that once your property is completed at the end, once you've got your OC, that sort of thing. So, there's lots of different ways that you can do it. So Yeah,
to
where
save
there's a will,
yourself.
there's a way. It just depends on how much you want to spend. But
yeah.
look, I think the long story short, if you're going to undertake structural renovations, you need to make sure that you can complete them, because you don't want to be in a situation where you've got an incomplete security and no one's going to give you any
I
money for
suspect
it.
that's what's happened with the property next door to my practice. There's like a wall still missing and there's still fencing around it. So
It makes it tricky. It does.
Yeah.
It can be done, but like I said, everything at a cost.
Yeah. All right. It sounds like the take-home message is, cross your T's, dot your I's, and make sure you know what you're getting yourself into. Don't be a cowboy if you're going to make structural changes.
Totally.
And
just engage your broker early, or engage your banker or whoever you're using. Just engage them early, because they're there to help you and make sure that it doesn't fall over. You might not want to submit an application yet, but you can do a lot of groundwork in the meantime just to make sure that you are ready to go when you want to go.
No, that sounds like a very good advice. And I think it'll stop a lot of people from saying, I can do this.
Yeah, totally.
Is that usually the situation? And you're like, I can do this. Or, I've got an uncle who's a builder and then we just decided to do it through
That's
them.
right. And I mean, look, and the reason people do that is because it's expensive and they think that they can save money by doing it themselves. But, if you're not experienced, you can quite often run into problems, and it can end up being more expensive than what you ever imagined.
Okay. So now before we go, I just want to ask one last thing, choosing a builder. I know it's a bit outside of your remit, but what is the best way to choose a builder? I mean,
I think
you come across these loans enough, so you see all sorts of builders, right?
You do. I mean, look, we do a lot of loans through your normal suspects like your Clarendon Homes, your Masterton Homes, very well established. They call them kit homes, but they're not really kit homes. They've got
They're high volume guys.
High volume, lots of runs on the board. I mean, if you are going to go for a custom builder, I would suggest just doing your research, find out who they've done builds for, ask around. I mean, referral is always a really good source of research. Who has, your neighbours up the road built with? What did they think of them? Quite often I think, the best source is peer referral. Who have they worked with? Are they easy to work with? Did they do a good job?
Yeah. Because it's such an opaque space, isn't it? There's no real reviews.
That's right. And you can't, essentially what you need to know is, do they have the cash flow?
Yeah.
Because that's the most pivotal part of the whole thing. Like if the builder,
so cash flow.
That's right. So if the builder doesn't have the cash flow, then that's a bit of a problem. So you want to make sure that they're, got enough runs on the board. They've,
Yeah.
Yeah.
And
I don't even know how you assess cash flow.
How do you assess
I don't know if you can
flow?
outrightly ask them what their cash flow is, but I suspect that just comes with volume and experience and referrals.
Yeah. Well, I mean, it's interesting because every now and then you see a builder collapse and it leaves
Okay, how does that happen?
How does that happen if there's a cash flow issue, right? Perhaps the way they built the economics into it is not right. And also a lot of construction companies just seems to fold up and then get reincorporated all the time. So how do you assess that? It's tricky.
Yeah. And look, they do have insurances and things in place to try and hedge a little bit of that, but it doesn't cover everything.
It doesn't cover when it's across the board, isn't it?
Yeah, that's right.
Okay. Yeah. All right. So lots of food for thought, and I think it's also giving me some ideas for future episodes. Get a builder, get a architect in maybe. Yeah. That sounds like a next steps.
Yeah, excellent.
Right. Thank you for joining us.
Thanks, B. Thanks for having me.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.